For our parents, the formula for wealth was absolute and unquestioned. Work hard, live below your means, and save 20% of your paycheck in a federally insured bank account. It was the bedrock of the American dream. It was the covenant between a citizen and their financial system. It was the promise that discipline would be rewarded. But as we cross into 2026, that bedrock has turned into quicksand. The promise has been broken. The covenant has been violated. And an entire generation has noticed. While the world's largest financial institutions are reporting record-shattering profits, JP Morgan Chase posted $49 billion in net income in 2025 alone. The average young professional is looking at their banking app in a state of quiet horror. The average interest rate on a standard savings account remains a stagnant 0.05%. Not 0.5, 0.05. That is 50 cents on every $1,000 you save for an entire year. When you factor in the real-world inflation of the post-2025 economy, keeping your money in a traditional bank isn't just safe, it is a guaranteed way to lose 5 to 7% of your purchasing power every single year. It is a financial trap, a beautifully designed, government-endorsed, federally insured financial trap. Welcome to the era of quiet quitting the banking system. In this investigative deep dive, we explore the radical psychological shift of a generation that has realized the gatekeepers of the old world are no longer on their side. We are diving into the rise of alt wealth, the phenomenon of doom spending, and the dark math that proves why safe is the new risky in 2026. This is not just a trend, it is a rebellion. Why save for a house that costs 12 times your annual salary? This is the central question haunting the psychology of the modern investor. It is the question that keeps financial advisors awake at night. It is the question that no politician wants to answer honestly. And it is the question that is reshaping the entire financial behavior of a generation. In 1970, the median house price in the USA was roughly 3 times the median household income. A working-class family could realistically save for 5 to 7 years and purchase a home outright. The math was difficult but achievable. By 2026, that ratio has exploded into a mathematical impossibility for the middle class. In cities like San Jose, Seattle, and Miami, median home prices now sit at 15 to 20 times the median household income. You would need to save every single dollar of your salary for 2 decades, paying 0 in rent, 0 in food, 0 in taxes, just to afford the down payment. When the big goals, homeownership, early retirement, stability, feel like they have been moved behind an unreachable paywall, the human brain undergoes a profound shift. Psychologists call it doom spending. It is not recklessness. It is not immaturity. It is a clinically documented psychological response to perceived financial hopelessness. When the brain determines that delayed gratification will never be rewarded, it stops delaying gratification entirely. Instead of sacrificing today for a future that feels mathematically canceled, Gen Z and millennials are redirecting their capital into immediate experiences. They are buying the $4,000 Apple Vision Pro or the luxury vacation today because the $400,000 down payment for a starter home feels like a fantasy. This is the quiet quitting of long-term planning. If the system is rigged, why play by the old rules? Data from recent consumer reports shows that luxury spending among those with less than $10,000 in savings is at an all-time high. Credit card spending on travel among adults aged 22 to 35 increased by 38% between 2024 and 2026. Fine dining reservations in major US cities are booked out 3 to 4 weeks in advance. This is not a generation that does not understand money. This is a generation that understands money too well. It is a logical response to a world where the currency is melting in your hands. We are witnessing a generation that has decided to live well today because they are being priced out of tomorrow. Let's look at the numbers the banks hope you never calculate. The numbers they hide behind complex fee structures and confusing fine print. The numbers that expose the greatest financial illusion of our generation. Imagine you have $10,000 sitting in a high-yield savings account in 2026. The bank offers you 1% interest if you are lucky. That means at the end of 12 months, you have earned $100. $100 on $10,000. Meanwhile, the real-world cost of energy, housing, and healthcare is rising at a clip of 6%. Do the math. You are losing $500 of value every year just by letting that money sit still. Your account shows growth. Your purchasing power is in free fall. This is the stealth tax. It is an invisible transfer of wealth from your pocket to the institution's balance sheet. It operates silently. It operates legally. And it operates with your full consent because you signed the terms and conditions without reading them. The bank takes your $10,000 and lends it out for mortgages at 7% or credit cards at 24%. They are making a massive spread on your capital while giving you back crumbs. On your $10,000, the bank earns roughly $700 in mortgage interest or $2,400 in credit card interest. They give you back $100. They keep the rest. You are subsidizing their record profits with your devaluation. This is why the plain bagel approach to safe investing is being questioned by economists and financial creators alike. In a high inflation, low interest environment, a savings account is no longer a vault. It is a leak. According to Economics Explained, the velocity of money is changing. People are realizing that holding cash is like holding a melting ice cube in a desert. Every minute it sits, it shrinks. Every year of inaction costs you real, tangible, irreplaceable purchasing power. The 2026 banking infrastructure is designed to reward the debtor and the institution, not the saver. The person who borrows money to buy assets is rewarded with appreciation. The person who saves money in a bank account is rewarded with evaporation. If you are still saving the way your grandfather did, you are not being responsible. You are participating in your own financial decline. So, if the banks are being abandoned, where is the capital flowing? Where are the quiet quitters putting their money? What does the financial rebellion of 2026 actually look like in practice? Welcome to the world of alt wealth. We are seeing a massive exodus of capital from traditional savings into alternative high-velocity assets. In the first quarter of 2026 alone, retail investment into decentralized finance protocols increased by 67% compared to the same period in 2024. In 2026, diversification doesn't mean a 60-40 stock bond split anymore. It means fractional ownership. It means decentralization. It means building wealth outside the traditional system entirely. Through blockchain-backed platforms, a 23-year-old in Ohio can now own 0.5% of a multifamily apartment complex in Miami, or a fraction of a Warhol painting. They can earn rental yields without a mortgage application. They can build a real estate portfolio without a credit score gatekeeping their entry. They are trading guaranteed low returns for speculative high growth because they feel they have no other choice to catch up. Then there is the AI economy. The most disruptive force in the history of labor markets is not just eliminating jobs. It is creating entirely new categories of wealth generation that did not exist 5 years ago. The 9-to-5 is dying because middle management jobs are being automated at a rate never seen before. 54% of tasks currently performed by white-collar workers can be fully automated using tools available today in 2026. In its place, a new class of solopreneurs is emerging. Individuals using AI to run entire agencies, content channels, and software as a service businesses from their bedrooms. They aren't looking for a paycheck. They are looking for equity. Business Insider reports that 42% of Gen Z now has a side hustle that earns more than their primary job. AI-powered content channels are generating $5,000 to $20,000 per month for individuals who 3 years ago had no technical skills. Faceless YouTube channels in the finance and luxury niche are being built and monetized faster than any previous era of content creation. This isn't just about extra money. It is about building a fortress that the traditional banking system cannot touch. The financial rebellion of 2026 is powered by code, decentralization, and a refusal to accept the crumbs offered by Wall Street. The banking system wants you to stay quiet. They want you to keep your head down and your money in their vaults while they use it to build their empire. They want you to feel that there is no alternative, that the system is too complex to navigate alone, that the risk of leaving is greater than the certainty of staying. But the Wealth Compass strategy for 2026 demands a different path. First, you must become your own bank. This means moving away from stagnant accounts and into high-yield cash accounts or money market funds that actually track with or beat inflation. In 2026, platforms like Wealthfront and Fidelity are offering cash management accounts with yields between 4 and 5%. That is not perfect, but it is 40 times better than what your neighborhood bank is offering. The gap between those who move and those who stay is compounding every single month. Second, invest in the ultimate asset, yourself. In an AI-driven economy, your ability to leverage new tools is your only true job security. The professional who understands how to use AI to multiply their output will always outpace the professional who refuses to adapt. Education in 2026 is not a degree. It is a continuous sprint. The most valuable certificate you can hold today costs less than $100 on an online platform and can generate 10 times your current salary in 18 months. Third, build a portfolio of hard assets. Whether it is Bitcoin, gold, or fractional real estate, own things that cannot be printed into oblivion by a central bank. The era of quiet quitting the bank is just the beginning of a larger great decoupling, a separation between those who trusted the old system and those who built a new one. You have to decide which side of history you want to be on. Will you let your hard-earned wealth evaporate in a 20th century relic? Or will you navigate the new economy with precision and courage? The direction you choose today will define your decade, not just your bank balance, your entire trajectory. Your children will either inherit a fortress or a debt. That choice begins right now. If you are ready to stop saving and start building, hit that subscribe button and join our community of navigators. Every week, we break down the exact strategies that the top 1% use to grow and protect their wealth, and we translate them into actionable, precise steps for the professional class that refuses to be left behind. The compass is in your hands. Thank you for watching.